In Chapter 6, Part A, we're going to study inventory and cost of goods sold. Inventory are the items that a company intends to sell to customers. It is an asset reported on the balance sheet, and it is considered a current asset because it will be converted to cash in less than 1 year. Cost of goods sold is an expense reported on the income statement. The flow of inventory costs is as follows. Manufacturing companies take raw materials along with direct labor and some charge for overhead costs and assign that to work in process. Ultimately, a finished good, such as a TV, is produced and is sold to a merchandising company, such as Walmart or Target. This will be our focus. We will focus on the acquisition of a finished good that is then sold to you or me, the end user. This is an important illustration of the flow of goods during a period. At the beginning of some period, we have what was left over at the end of the prior period. This is our beginning inventory. We will account for the acquisition of purchases during the year to get our total inventory available for sale. At the end of the period, we will still have it, representing an asset on the balance sheet, or if we no longer have it, we will charge it to the income statement as cost of goods sold. Here's an example. To illustrate using the graphic we had before, we began the period of $12,000 in inventoriable costs. We purchased $63 during the period and had available for sale $75,000 in costs. When we counted the units at the end of the period, the value assigned to those units was $18,000. That means the cost of those units sold must have been $57,000. In this example, we said at the end of the year, when we determined what assets we still on hand, the cost associated with those assets was $18,000. Next, we want to investigate the question, how do we determine what the cost is of the units we have on hand during the period? There are 4 different methods to assign costs to the ending units of inventory that we have on hand. The specific identification method would match to each unit of inventory its actual cost. This is practical, however, only for unique items such as jewelry, art, or collectible cars. If specific identification is not possible or practical, we will have to use an assumption. It's important to understand that these methods do not have to correspond with the actual flow of goods. It is simply an assumed flow of goods for purposes of tracking costs. The first method we will examine is FIFO, which stands for first in, first out. The assumption here is that the first units purchased are the first ones sold. An alternative assumption is LIFO, that the last units purchased are the first ones sold. To illustrate, assume that in January we bought a box, and then in March we bought a box, and in June we bought a box. And let's assume at the end of the year we have 1 box remaining. The LIFO method of inventory costing would assume that these 2 were sold, that this one is in ending inventory. Last in, first out. Next one in, next one sold. In contrast, FIFO would assume that this was the first one sold and that this was the next one sold. Consequently, the assumption is that this last box acquired would be an ending inventory. A third assumption is simply to average. We'll use a weighted average, which takes the cost of all items and divides it by the number of units. It is important to have totals in both the numerator and denominator in order to calculate the weighted average. Once we've calculated the per unit weighted average cost, we will multiply it by the number of units sold during the period to calculate cost of goods sold. Calculate the ending inventory asset value, we'll take the weighted average unit cost and multiply it by the number of units on hand at the end of the period. Let's look at an example of these 3 cost flow assumptions. FIFO, stands for first in, first out. In this example, we began with 1,000 units and we acquired 3,500 more, totaling 4,500 units available for sale during the period. If we sold 3,000 units, the FIFO assumption is that these were the first ones sold, then these 500, and then these 1,500. In total, these would be our 3,000 units sold. The cost of goods sold, therefore, would be 16,000. These 1,500 units would be assumed to be on hand at the end of the period, and our asset value would therefore be $10,000. Here it is illustrated in red. Our cost of goods sold and our ending inventory. Notice that we've taken the 26,000, our total costs available for sale, and allocated it either to the income statement as an expense or to the balance sheet as an asset. Let's look at LIFO now. Recall this stands for last in, first out. So the 3,000 units sold would first be deemed to come from our December purchase, then September, and then July. The cost of goods sold charged to the income statement would therefore be these 19,000 in cost, and the cost remaining on our balance sheet as an asset would be this 7,000 in cost, representing these 1,500 units. Notice that we're taking our total available for sale in terms of dollars and allocating it either to the income statement or to the balance sheet. A third alternative is to calculate a weighted average cost. Here we will take our total costs and divide by the total number of units. The weighted average cost per unit is $5.78. We will take the $5.78, multiply it by the units sold to calculate our cost of goods sold. We will take the unit cost, multiply it by the units we still have on hand to calculate our ending asset value. As with LIFO and FIFO, notice that we're taking the total available for sale and allocating it either to the income statement as cost of goods sold or to the balance sheet in our ending inventory. Notice that the choice of inventory method does not affect our sales revenue. We will acquire inventory at some cost, but the price at which we sell it depends upon its value in the marketplace to the customer. In each of the cases, our sales revenue is $40,000. The difference lies in how we assume the flow of goods. In the case of FIFO, our cost of goods sold was $16,000, LIFO was $19,000, and under the weighted average method, $333. Notice that we get different gross profits in each of the three cases. So you might be wondering, why would a company choose FIFO? Why would a company choose LIFO? In periods of rising costs, which is often the case and was in our example, FIFO results in higher ending inventory, lower cost of goods sold, and higher net income. Assume, for example, in January we acquired a box that cost $1, and then in March we acquired a box that cost $3, and in June acquired a box that cost $5. If we sell two boxes, first in, first out, we're going to assume that our cost of goods sold is $4 and that we have $5 of ending inventory. Notice how this compares to the LIFO assumption. Last in, first out would be assumed to have sold the last two acquisitions. Our cost of goods sold would be $8 and our ending inventory would be only $1. So notice during these periods of rising prices from 1 to 3 to 5, under FIFO we have higher ending inventory. We've got ending inventory of 5 under FIFO versus only 1 under LIFO. Our cost of goods sold under FIFO is only 4 as compared to 8 under LIFO. And if cost of goods sold is lower, our net income is going to be higher. If during periods of rising prices we get higher net income under FIFO, why would we ever choose LIFO? Generally, companies prefer higher net income. The answer is tax savings. Companies would prefer to report lower earnings for tax reporting purposes. And if costs are rising, LIFO will give that result. LIFO will result in lower ending inventory, higher cost of goods sold, and therefore lower net income, and consequently less taxes paid. But why not use both? Why not use FIFO for financial reporting purposes and then LIFO for tax reporting purposes? We could have the best of both worlds. The answer does not lie under generally accepted accounting principles. The answer is tax law, as established by Congress. Congress says companies can't do both. Companies that want to use LIFO for tax reporting purposes must also use it for financial reporting purposes. Because FIFO and LIFO will result in differing amounts for inventory and cost of goods sold, we have a challenge to obtain comparable accounting information that would allow us to compare companies who use differing methods. Generally accepted accounting principles helps us address this problem by requiring companies who use LIFO to report an as-if FIFO inventory number. The way in which companies do that is by disclosing what is called the LIFO reserve. The LIFO reserve is the additional amount that a company would have reported if it used FIFO instead of LIFO, and it is reported in the notes to the financial statements. If, for example, a company using LIFO had an ending inventory of $1 and under FIFO would have reported ending inventory of $5, LIFO reserve would be $4. The LIFO reserve would allow a financial statement user to take the $1 inventory value reported on the LIFO financial statements, add to it the reserve, and calculate an as-if FIFO number of 5.